Today's Talk About It Tuesday question is, when saving for children in their future, as far as giving them a head start. Doing my own research, I can only come up with opening a CD account, 529 plan, and perhaps opening a life insurance policy for them that earns cash value. All of these can become a burden financially if I venture into all of them. Which one of the three would make the most sense for a child? And if none of the three, what do you suggest as a good savings plan to create for a child that can give them some type of start to a healthy financial foundation when they reach adulthood? Whew, a lot to unpack. Had to put the glasses on because it was a long question. So first we have to start off with what your goals are, right? And saying a head start doesn't really give a clear definition of what you're trying to accomplish by putting away money. So I think you can have more than one goal, but they have to be very clear because the strategy that you take should be dictated by the outcome you're trying to get. So let me make that more clear for you. Are you putting away money for a college education or trade school? Are you putting away money for them to get married in terms of helping to pay for the wedding? Are you putting away money for assistance on a down payment for their first home? Are you putting away money for them to start some entrepreneurial venture when they hit a certain age, right? All of those things require a different amount, and you can take a different avenue towards each one. And like I said, you could have multiple, but if you're on a budget, you have to be realistic also. Which one is most realistic for you to achieve? Which one is sustainable? When I say sustainable, you have to be consistent in terms of your investment or your savings, right? Because it's compounded growth that is the key to the success of whatever investment or savings plan that you have for the child. So can you sustainably do $500 a month for the next 20 years? Because you got to think 20 years if you're thinking about a child, right? 20, 21 years, maybe 25 years you're considering. So you have to keep that in mind, what's sustainable for you over that period of time. Then we have to look at, because of the time duration, the risk factor, because in that time, 20, 25 years, the economy will go up, it'll go down, it'll go up, it'll go down, and certain investment types will be affected by poor economies, while others, when those are down, will be up. So we still have to think diversifying the portfolio. We can't do something different for a child in a long-term portfolio than we would do for ourselves in terms of diversification. So as far as choosing one, not necessarily a great strategy, putting all your eggs in one basket. But before I get into how I would create a diversified portfolio, let's talk about the three that the questioner asked about. So the questioner said he did his own research, and that's a dangerous thing. I think you should always use a professional. Even with AI, right? If you put in the wrong prompt, you're going to get the wrong answer, right? So he said he came up with a CD, right? And a CD is a certificate of deposit. I don't think that's a good long-term strategy because CDs generally pay a high return in a short amount of time, right? 6 months, 1 year, 2 years. They're not a 20-year strategy. A CD is not a 20-year strategy for good return. You can get comparable interest on a high-interest savings account. You can get comparable interest on a high-interest savings account with a greater amount of flexibility so that you can take money in and out at will for a high-interest savings account. So over the long term, I think it's better because there'll be sometimes you'll scale back in terms of how much you put in there. Sometimes you put in a CD, you can't add more, by the way. It's fixed. It's a fixed amount with a fixed return for a fixed duration. So it's not like you'd have to keep buying new CDs. So that's not a good long-term strategy for saving for a child or an adult for a long-term strategy at all. CDs, no good. So the alternative to that, if you want interest income, would be, again, a high interest savings account, or people have forgotten about savings bonds. So the Series E savings bond is guaranteed to double in value. Your purchase, whatever you purchase for, is guaranteed to double in 20 years. The government guarantees doubling. So if you buy $10,000 worth of savings bonds in 20 years, you know it's going to be worth $20,000. So if you just wanted something fixed that can't be touched, that has a definite guaranteed outcome, then I would do the savings bond over a CD, right? So, and I'm not necessarily saying I love savings bonds. I do not. I think you can do better. But if you want something fixed that can't be touched, right, like a CD before long term, then I would definitely do Series E. The other thing was the 529 education plan. I have done a video on the 529, so please search in my portfolio of videos. I've done 529. I think the 529 is a decent investment for what its purpose is, which is to finance a child's education. Other than that, if the child doesn't go to school, I don't think it ends up a good plan, because I think you can do better. And so you're kind of banking on your child going to college. And if they are, then this definitely can be a part of your portfolio. No issues with that whatsoever. The third thing the person asked about was a cash value life insurance policy. I've probably done 10 videos. That is a horrible, horrible, horrible investment. As a matter of fact, it's not an investment. And I think you're setting your child up for disaster if you're telling them that the point in doing this cash value thing is to borrow against the money. It is a death benefit. So here's a better strategy if you want to get your child life insurance, which you should, right? Because, I mean, unfortunately, you never know when somebody's going to go. But all you need is a term life insurance policy, probably a rider to your own, that is enough to bury them, $10,000, $20,000, enough to bury them. That will cost you $10 maybe. Could cost $10 when they're young, $20 for you a month. It is for a term. When they turn 25, usually when it turns 25, then that term expires for them and they have to renew. And what happens is, of course, at 25 now, they might have different needs. So they might have a spouse, they might have children, they might have, some reason to increase the death benefit. So they'll pay more, but they'll get an increase in benefit. It will be less expensive for them to renew that policy at whatever the rate is than if they got a new policy starting at 25. So giving them a head start, that does give them a head start. But cash value, no good, ever. That's horrible. Don't do it. Term, that's it. So of those things, 529 is the only one that I think makes sense if you're going to, choose one. And again, you're banking on this child pursuing a higher education. So what other things would I suggest? I would suggest, and I think the king of all long-term investments is the index fund. The index fund, and you can put a small amount in over 20, 25 years, definitely going to get at least 10% return. It has historically done that over 25 years, a little greater than probably 11% over 25 years. But there are years, I think last year, 21%, currently like 16%. You'll do well in a long term with an index fund. It's passively managed, so there's not a lot of fees. Of course, you don't pay taxes on unrealized gains. You'll just do well, right? It's very low risk, high return for the long term. Other than that, I think it would be very specific to what you're trying to accomplish for your child. But those are the things I would do: an index fund to deal with the stock market. I would do some fixed interest, maybe in a long-term Series E savings bond. I would definitely do the high interest savings account. If you want to bank on education, the 529, and term life insurance over whole life insurance all day, any day. And now here's the thing. I would involve my child in this process as soon as they are old enough to understand, and I would have them contribute to these things, right? Especially when they start getting a summer job, or they make a little side hustle, whatever it is. They need to get in the habit of contributing so they develop a lifelong habit even after you turn it over to them that this is a lifelong process. I did that with my kids when they were young. They all had little piggy banks. That's when the habit starts. Whenever you get a little extra, you create extra money, right? Or you teach them how to budget. It's never extra. You teach them how to budget. So a little bit goes here. You can spend some, but always put some in your savings. They developed that habit. When they got older, then it's like, okay, now you got to get a bank account. You got to fund your bank account. Now when you get a little older, you open up a brokerage account, right? Because you got to be 18 for them to actually have their own brokerage account. But now you fund your brokerage account. Now you do. So I've always included my children, and now they've developed a habit as adults that they continue that practice of investing for themselves for the long term. So that's my strategy. I'd love to hear your thoughts on it. Please like, share, subscribe. Keep the questions coming, and I'll see you next Tuesday.